Ever wondered how to build your own single stock portfolio? Or have been considering adjustments to your current holdings and need a fresh start? Stay tuned, guys, as we're going to delve into the step-by-step process that will help you build your own diversified portfolio of individual stocks. So where do we start? The answer for the majority of investors, the S&P 500, or top 500 list of companies by market cap. While the Magnificent Seven often steals the spotlight, remember, if you're holding the major indexes like SPY or QQQ, you're already likely to own these. But if you're aiming to construct your own portfolio of individual stocks, we recommend making a start with more widely held large cap, dividend growth, or more conservative value and moderately high dividend-oriented names. These types of stocks can be found within the top S&P 500 stocks list and culled through based on your own expertise, interest, and suitability. Now that you know where to start, what's next? Start by looking at the big names, the large cap stocks from the S&P 500. But here's a trick: skip past the top 10 by market cap. Why, you ask? It's simple. There's a high likelihood that you already have ownership overlap with the indexes if you hold positions in funds like SPY or QQQ. If you feel compelled to pick from the top 10, limit yourself to just one. Like, say you favor Apple as your favorite phone or Amazon as your favorite retailer that has repeat orders coming to your door each month. Then go with just your one top mega cap, but remember, it's likely you're already holding some through overall stock investments in other ETF and mutual funds. Now let's add a personal touch to your portfolio. This might seem a bit unconventional, but investing isn't just about numbers, it's also about understanding. So look at the list of stocks and consider the names that are most familiar to you. Think about your work life, your career industry, your hobbies and passions. You might be wondering, why would I consider my hobbies while investing? The answer is simple. It aligns with one of the golden rules of investing: buy what you know. If you're a tech enthusiast, you might be more inclined towards understanding and tracking tech stocks. If you're passionate about sustainable products, you might be more interested in companies that align with those values. This personal connection not only makes investing more enjoyable, but also gives you an edge. You're more likely to understand the market dynamics and future prospects of these companies. Plus, you'll be more inclined to stay in the game when market volatility happens, and your convictions will be tested. But remember, personal interest is just one factor. You still need to consider the financial stability of these companies, their performance, and their future growth potential. And that brings us to the end of our second step: creating your shopping list. So remember, it's crucial to invest in what you know. This personal connection can be your secret weapon in the world of investing. It can help you understand the company and its prospects better, making you a more informed and confident investor. It's not just about the money, it's about making investing a more engaging and enjoyable journey. But now that you have a list, it's likely too long to invest in everyone you listed. The idea is to find just 5 key stocks to focus on. Why 5? Well, we recommend striking a balance between not putting all your eggs in one basket or diversification, but also being able to follow up with daily and weekly updates, financial news and information that may impact your time and inclination to monitor each single stock position. If you've made it this far, please consider giving this video a like, share with a friend, and subscribe to support our work of helping wise investors. We really appreciate it. Next, let's focus on the dividends. The dividends, those regular payments made by a corporation to its shareholders, usually in the form of cash or additional shares. They're a fundamental aspect of stock ownership and valuation. We suggest that you pick at least 3 stocks from your list that pay dividends. Why? Because dividends can give you a clue about a company's stability. A company that has a history of paying regular dividends is more likely to be financially stable. But don't just focus on the dividend yield. Sure, a high dividend yield can be attractive, but it's not the only factor to consider. Some growth or moderate growth stocks may only offer a modest dividend yield of 1 to 2%, and that's perfectly fine. The key here is the company's financial soundness. Also note that extraordinarily high dividend yield may actually be a red flag, say a yield over 5%, meaning the cash flow of the company could be unsustainable if paid out at too high of a rate. Be sure to research dividend payout ratios carefully for each company. So how do you evaluate a company's financial stability? Look at the current dividend yield, certainly, but also consider the annual share buyback rate. This is when a company buys back its own shares from the marketplace. It's a way of returning money to shareholders and can indicate a company's confidence in its own financial health. And it should be evaluated with dividends as a combination of shareholders' return. Next, check out the company's growth in revenues and earnings per share. A consistent growth in these areas is a good sign, but remember, these factors are not static. They should be evaluated and monitored for as long as you remain a shareholder. A company's financial stability and dividends are significant factors to consider when building your portfolio. But remember, the goal here is not just to chase dividends. The goal is to build a balanced, diversified portfolio that aligns with your personal interests and financial goals. So while dividends are important, they're just one piece of the puzzle. As we move on to the next step, keep in mind that building a successful portfolio is not a sprint, it's a marathon. It requires patience, diligence, and a willingness to learn and adapt. So stay tuned as we note a few final factors. Finally, let's consider the management and values of the company. This aspect, if you will, is more art than science. It's here where we dive into the depths of how the company operates, how it handles marketing, compliance, reputation, cybersecurity, employee relations, and even how it deals with unions if applicable. It's important to look into past or pending legal matters, regulatory oversight, and public relations. These elements can all provide valuable insight into the company's culture and operational style. Now, it may sound complex, but it's not as difficult as you might think to identify best-of-breed companies in their respective industries. You see, a company's management and values can significantly influence its success and stability. So paying close attention to these aspects is crucial when building your single stock portfolio. As you're going through this process, it's likely that a few things will naturally come to light. You'll find yourself asking questions like, do I have personal experience with this company? Is my understanding of this company based on my education, training, work-life, hobbies, or interests? Does the company have a competitive advantage or economic moat around its core business? And can I easily understand the company's product or service and explain how they make money? These are foundational questions that you should be asking before selecting a stock. They help you to understand the company better and make a more informed decision. Additionally, consider the current dividend yield, dividend growth rate, revenue growth, and earnings history, and growth rate over the past 1, 3, and 5 years. Look at the company's financials. Is it profitable? Does it have debt? Building a single stock portfolio is more than just picking stocks. It involves understanding the company, its management, and its financial stability. Stay tuned for our next video where we'll discuss diversification and how to build a position carefully over time.